Hi, I'm Martin, and welcome to the Cashflow Control Room. Today I have Victor as my guest, and I'll let Victor tell you all about himself.
Thanks, Martin. Hi, everyone. This is Victor Zhou here. I'm a fractional CFO, and in the past decade, that I have been providing service to one industry, that is construction. Through our years of experience, we helping to create financial clarity in the construction business, helping them to uh, understand the numbers, understand what the future holds, see the risk and potential opportunities, and be able to make the right decision based on valid data.
Yeah, I suppose one of the things that Victor and I did for the first time for a couple of clients is actually use trade finance in construction. And trade finance is a great solution for the problems associated with cash flow in construction, because you have, once again, the classic cash gap that you have the time in between you pay your suppliers and your staff until you eventually get paid on the other side. So trade finance has the ability to provide a facility where you can pay your creditors. Instead of paying them at 30 days, you can fund them and pay them at 90 days, which helps match the cash flow. And we've done that on a couple of cases, Victor. And perhaps if Victor can give us an idea of the difference it made to the client's cash flow.
Oh yeah, absolutely. I remember there's a couple cases. One of the most impressive one was a contractor that we helped together, like right after they went through the financial difficulty, and they have to start fresh and having a lot of a challenge in the working capital. And at that time, no other banks or financial institutions is willing to support the business, but that we could work together using the trade finance facility to leverage that his debtor to mobilize the working capital so he can be confident to take the project that his business normally would be dealing with, right? One big difference I see in construction is that you have a lot of talented people working in the construction, right? The talent is normally not the key difference between the well-performing business and a business that go bust. The key difference is actually how you manage your cash flow. Being working in the construction for a decade, that I have never seen a construction business go broke because they have not enough work, right? That barely happens. But the construction also being recalled for the highest ratio for the liquidation, always, right? And I can see the key difference here is on managing the cash flow. And in seeing that, I can see that working capital solutions, especially when it comes to the trade finance facility, and debtor finance facility, that whether a business can manage that right, whether a business can utilize that facility to mobile their cash flow, is a lot of times a key difference between good, bad, and not survive.
Yeah, and look, I would tend to agree with that, Victor. I think that while I can provide cash flow tools and do things like debtor and trade finance that can make enormous differences to cash flow, it's still important how that cash flow is managed on a project. And that's where, particularly, I see a lot of trade based businesses and builders aren't often bringing in enough expertise from the financial side. They have great contract administrators, they have great subbies they work with, but often the back office, for want of a better term, is not as well managed as it could be because they just don't have the expertise. And I see many construction companies that have accountants that basically see them once a year and do their tax, and are what I call compliance accountants, as versus the proactive style that you use and using your cash flow modeling and so forth, manage them to see how valuable a project can be and maintain profit. Because with a few variations, a project that was looking quite profitable can fall down the toilet.
Yeah, absolutely. It's very interesting that you mentioned about that fact that traditionally speaking, there's a gap between the back office and front office, as in regards to what the business has completed, right? And how to measure what you complete and be able to understand what's going to happen. So it's not that people hasn't put enough focus on this, but there hasn't been enough support provided by that can be offered by the bookkeeper or by their traditional compliance accountant, as you mentioned. So it's interesting that like we looking at this as a three-layer system. All right. The first layer is your mechanism, which is what kind of system that do you use? These days, we still walking into a builder's office and seeing a majority of the record keeping is done by Excel on the projects, or people just simply rely on their accounting system to tell where they are with the business, which is not sufficient. So I would say that having that layer, having a digitalized construction management system is the number one thing that business need to look at, right, in order to managing the financial information. And the second thing is the input, right? That's when you start having a system that you can have a software like a Protocol, Builder, Trend, Wonder Build, they all providing good system. But then the next level is what kind of information that you actually put into the system. There, if we like, for example, if we only record a budget in the system, but we forget to track, or we don't have a standard operating procedure that team is following to put in the data on a monthly basis, you get nothing out of that. Full stop. Right. And that system can only help you do the contracting, not the management. Right. So it's only when you have the valid input into the system, then you actually build a foundation for further analysis, which is the third step, which is the output of from that system and that data. That's when we sit down with client on monthly basis, fortnightly basis to go through the data to to zoom out and zoom in. What I mean is, like, as a business owner, you don't want to looking at every transaction. That's too much of work, right? So you need to zoom out, looking at the project, like having the key metrics. What is your project to date? What is your project to date budget? What is the project to go budget? What has changed in your project? What has changed on the schedule? What has changed on the money? What each project is going to look at? What overall business looks like? How is your running cost change? These metrics, right, are important, but it sounds complicated, but doesn't take you more than 30 minutes to go through all the metrics every month. And once you go through the metric, you have your original budget, right? You can compare what has changed, and then once you see the change, you zoom in to the transaction level detail for that area to identify what really changed in the business, why it's changed, and create a solution to mitigate the financial impact. So that's end to end. But also, if you have these three layers built up properly, and you have a fractional CFO like us or someone else looking after the business, then you shouldn't spend more than like 90 minutes a month to understand fully about what happened in your business financially and create a solution that can mitigate the risk or utilize opportunities.
Yeah. And look, I'm using your three-layer model. I know there are some really great construction tools out there, but once again, the problem is input. It's you can load up a new piece of software and away you go, but the actual problem of getting the correct input regularly, and tracking what's going on. So this is one of the areas that I've seen constantly as a bit of a drag. And once you empower yourself, as you said, and put the right inputs into the right system, you can very quickly see how the business is tracking. And forewarned is forearmed. I think that a lot of business owners look at what's not in the bank or what's coming in, and don't really understand how expenses and profitability and cash flow all sort of match up. And this causes a lot of heartache for them. But with the right sort of tools and properly implemented, they can get a good handle of their business. Because what I often see, and when you come to the finance side, you look very closely at these things, is that sometimes people are very good at constructing and doing that thing, or they might be plumbers, or they might be electricians, and they're very good on the tools, but it's often a need to sort of re-educate them to the financial realities of running a business, particularly as the business grows.
Yeah, absolutely. And I think that's probably the biggest trap that in the construction business, that it's too easy to grow, right? Quite often that I'll sit down with a contractor, that first thing that they will be talking about is next 5 years plan, right? How do I grow from right, a one-man brand to the current office that having dozens of people working for me, and where my business is going to be in like next 12 months, next 5 years, what kind of opportunity that we have. And then my reaction to that is normally like, okay, that's great, right? Now let's look at the book. And that's when you start seeing that people showing a different face, like, oh, okay, now let's talking about challenge, right? But the reality is, for a good operator, right? Like for people who know how to construct, the market will reward them very quickly. The reward them with more projects, with higher value contracts, and it's every contract value can anywhere between a couple $100,000 to a couple $1 million, right? And so it's very easy to build up that revenue, and people judge you by revenue these days. And so it's very easy for people to get that feeling of success, and then they just want to keep traveling on that path, keep feeling success. But at the same time, that feeling of success also made them sort of ignore the underlying risk they face in the business, and finance being a big part, right? Because you can always keep going, you can always keep leveraging, right? You can always borrow without asking from people that you work with for a while. And when you have that momentum of growth, people are willing to give you that credit until they feel enough. And that's why I remember we had this discussion about borrow when you can, not when you need it. That's the exact journey that
Yes.
we talk about. Like
Yeah.
a lot of business, this is a question that I come back from time to time when I'm talking to builder and contractors, and people asking, I have money in the bank, right? Why do I borrow? I know that the payable ledger is building up, but people are willing to work with me. People are giving me the credit. So why do I need more money? The answer to that is like, it's like I give them example. It's like buying a house, right? You invest in, you start taking a project, and what we need to realize is every project that we take is like an investment. You invest not just your skill but also your working capitals into that projects. So the more projects we take, the higher volume that we do, the more working capital that we need to put in. When we try to leverage with our supplier, which is not wrong, but if we try to leverage on that, that we're pushing that to the edge very quickly. And when we push them to the edge and we're trying to come back to the finance again, there's much less options.
Yeah.
And it's much more difficult.
That's right. Everybody tends to go too late, because the best time to borrow money is when you don't really need it. And I know that sounds strange, but and I often quote the example. Let's say, to keep it simple, the business has $1 million turnover. It's going to have $200,000 worth of debtors, so it has to have at least 200,000 working capital. And then you grow the business and you grow it to $2 million turnover. Well, then all of a sudden you need $400,000 working capital, and people don't have it. So that's where you have to look at using tools like debtor and trade finance to solve that gap, that cash gap that occurs because you just don't have enough working capital in the business. And someone who's had a really good year and has reached that, let's say, $1 million turnover, they need to think about what's going to happen when they're at $5 million turnover. Because, as you know, and you can see, many construction businesses can grow rapidly. And I think some clients of yours we discussed some time ago weren't builders, but had a building business because they'd been left over from Porter Davis and they were project managers. And because they were project managers, they brought a different attitude and a different understanding to construction than what many conventional construction people do, because their training and expertise was in project management. So they saw a building job as not look at those bricks, look at the project that we're fulfilling.
Yeah, absolutely. Absolutely. A lot of the builders that I come across, they grow up from that project management point of view. But there's also one thing that I see in that area, which sort of something that they didn't learn while they working as a project manager, because a lot of majority of project manager, they're in charge of their own project financial performance. They're not in charge of the overall business financial performance. So quite often they overlook at how much it really costs to run the business. So this is something that I quite often come across, that when you sit down and you're looking through the project from the budget stage, that a lot of times the builders putting in what we call a preliminary cost, which is trying to cover the running costs, insurance, everything. That number a lot of times are based on assumptions or based on a year-old data, right? Which is no way near how much it really cost them to run the projects. So a lot of time that we see from a loss is built start from the estimation, right? Not because they don't know how much it costs them on site, but because they are making assumption on how much it keep them to run business offsite.
So they're sort of looking from the lens, here's my project, I'm studying, working through, and I'm making a proper bottom line on this project, but they're forgetting about the rest of the business and the fixed costs and the overheads that are outside the actual project, their administration, back office, that sort of area. Is that what you mean?
Yeah, exactly. So what we suggest for the contractors to do is keep coming back and review your running cost on a quarterly basis, right? Or do it as ad hoc practice if you start adding major expense into the business. For example, you have to hire a construction manager that you need to pay 250 grand, or you bought equipment that you have the finance cost increased. So all these and interesting, some of the running costs is actually off the profit loss. So you cannot just looking at the profit loss say that this is how much money that I need to charge. You actually also need to looking at your the mortgage that we have, the other financial commitment that we have, the money we take off from the business without declaring them as wages. Right? That's really how much money the business need. And using that to build a module of how much running costs that you need to charge on each meter that you build this year. So once you have that running cost calculated right, then there's barely any chance for you to lose money on the estimation.
Right. Yeah. But how are you finding builders are dealing with some of the price increases I'm hearing about due to the fuel shock and the war we're facing now? Is that having much impact on them?
It's very interesting. Like, to be honest, the real impact that we observe is much less than what we forecast. Right. I'm not saying that there's no impact. There is impact. Like we see an average about 3 to 4% increase because the distraction cost on the other side of the world. But that 3 to 4% normally is a big impact already, right? So, but what we observe is the builder sort of having the mentality saying that, okay, yeah, we will absorb that, right? We will reflect that in our future price, and we will move on. The real impact in on the construction from this time is much less than the impact caused after pandemic, right? Um, and I think it's sort of, to a certain extent, it's probably like builders sort of experience the pandemic, which is big impact. Like you literally have some of the price doubled in just a 6 months time, right? And they sort of build up that resilience in their mindset and saying that we expecting the same thing to happen again, right? And when they actually see the impact is about like 3 to 4%, and most builders are like, okay, not as bad. Let's move on. But if we're looking at that, that's also a sad story, isn't it? Right?
Yeah.
For an industry to take a hit twice
Yes.
in over 2 years.
Well, and I think that what I'm hearing about and is happening in the larger end of town is that unfortunately funding and the banks, and if we just take residential building as an example, they force fixed price contracts. And the reality is that a fixed price contract is what destroyed most of the construction industry during COVID. You're right that there's been built a different resistance and a better understanding of the numbers, and so this shock is not as bad. But I think I'm seeing that sometimes it's possible to negotiate with the customer or the end user that these are the variations we're facing in this project, and we need to look at meeting somewhere in the middle. Otherwise, it can't be complete. Are you seeing many builders negotiating with their contracts in light of these price increases?
Yeah, we see that happen everywhere, right? From the contractors to the builders, this is reflecting in their new code already, right? So definitely this one is happening, right? And but I also see there's a mixed market, right? What I mean by that is we hear on the news, in the media, that the housing market, the price is falling, it doesn't look good. And we do observe in a lot of residential areas, there are less investment. That what that means is in the market it become more competitive, right? There's builders competing for fewer jobs. So on one side, most builders that we talk to, contractor we talk to, they have the awareness that the price need to increase to reflect the cost. On the other side, they also facing a higher competition where you always have people that will try to get the job first, worry about the profitability later. And these builders, these players are not going to be in the market for long. Normally, you give them 5 years. However, the distraction would be caused by their behavior, right? That's the reality. So what we like is and it happens in different areas. This year it happens in resi, right? Last year it happened in commercial. A lot of commercial projects was slow starting or delay in last year. So a lot of commercial contractor struggled last year. So what we normally suggest people do in this scenario is do the scenario test of your business. What if scenario? What if there are no new project that we can land it in the next 6 months? What is the cash flow going to look at? Right. And start creating the plan now when we still have the money, right? And whether it's setting up a new facility that can support the working capital, support some spending, or we start looking at saving the cost, changing the team structure earlier, have the plan, understanding how much a redundancy will cost us. And that's important to have that in plan, right? It's not saying that we are going to trigger any of these plans, but key difference is whether you need to prepare a plan under crisis, or you actually have the plan. So you start building up the reserve to prepare for the worst scenario, and that's a big difference.
Yeah. And I'm seeing, I've got an example in the software industry where AI is making changes. And when I recently spoke to Nigel, one of the situations were the cost of redundancy and restructuring your workforce can be very expensive. And particularly in immediate cash flow, like the long-term returns are there, but hey, if I restructure my workforce and replace X number of people with whatever, I've got a big upfront cost to actually change that. While my long-term outcome is going to be great, it can have a big impact on cash flow at that time. And if you move early, you've got the liquidity and so forth to be able to deal with that issue. But if you're doing it when things are already tight, you get a situation where it's cheaper to keep paying them than offer them redundancy. So it's an awkward situation many people face.
Yeah, absolutely. That we do find that normally is a big challenge, right? Managing the HR, managing the redundancy. What's what I notice here is a lot of times people put that to the last on the to-do list because of the emotional feeling. They feeling bad of letting the people go. So they tend not to dealing with that problem until they don't have other resource. But unfortunately, in this scenario, what we're talking about is if you don't have other resource, then that means that you probably don't have the reserve to even meet the money capital that you need for this redundancy.
We both know as being leaders and running our own businesses that unfortunately you do have to make hard decisions sometimes, and particularly in small business, staff members almost become family. It's things get very close in a smaller business, and it gets very, very hard to make those decisions. I know I've had to do it in the past, and it's just natural human nature to make it the last thing on the list because it keeps getting pushed down to the bottom of the to-do list because it's not only financial pain, but it's emotional pain. But if you don't care about your employees and don't have that emotional pain, then perhaps you're not that good an employer in the first place, I suppose.
I 100% agree on this. And a lot of times that we see is a business owner taking that much responsibility that they actually sacrifice themselves, sacrifice their family to meet what they want to do, right, for their employee, right? So, and that's another thing that we come across in this industry, that being working hard for years and people treat you with respect, right? Because you're helping them. Where are we leaving ourselves and our family, right? So it's actually a very simple question that we need to ask ourselves. Do we press every job to the break even, or do we press every job with a profit, right? It sounds like a stupid question, right? Because most people will say, of course, I price for profit. And then the next question is, where is your profit? If you plan for it, where is your profit, right? If we deliver what we say that we are going to deliver, shouldn't that we be able to take a profit before we pay anyone else and be able to using that profit to create the wealth? And if we do that consistently, the wealth creation is about momentum, right? If you do it consistently for years, then the wealth is going to be created for the family, right? And the fact that we couldn't do that, it should be a reflection of either that the we haven't really delivered what we say we are going to deliver, or when we deliver the result, we use that money to expand the business and to spend on things that is more fancy for the business. I'm not saying buying luxury cars, right? Majority of the business owners, they're not chasing that kind of stuff.
Yeah.
Just more things that they probably don't need at the moment, right? uh, this is what I tell people, like, if you don't give your dollar a purpose, your dollar would find purpose by themselves.
Yeah, that's very true. And when we talk about family and wealth creation, one of the things that I see constantly happening in Australia, which, for example, doesn't happen in the American financial system, is that so many builders and subbies and people in the construction industry have to leverage the home, the family home where they keep mum and the kids. And I don't, and it could be dad and the kids, depending on what area, but
Yep.
nevertheless, it's a thing that I try and avoid at all costs. And in the majority of situations, using products like debtor and trade finance, you can improve cash flow and not risk family homes with a mortgage to the bank. When you've only got one bank, it's like only having one supplier. You become a subcontractor to your bank. People just need to understand that they need to have some diversity in how they borrow and what they do, and spread their borrowing risk just like you would spread investment risk, multiple sources. So, the bank will be part of it, but there should be other lenders and other funding mechanisms in there so that everything is not locked into one. And if you have multiple lines of funding, you have some redundancy, because if something goes wrong in one area, perhaps the other areas can compensate. But if you're with a bank, and let's say, for example, during COVID, and you're a residential builder, well, see you later. We're no longer interested. And these are the things that people need to be careful of. And diversity in debt is just like diversity in investment, I think.
Yeah, absolutely. It's like you mentioned a very good point. Um, if we're treating the business as an investment, which it is actually an investment, um, like we're never going to buy a property with full equity from ourselves. We always try to leverage, right? And people try to leverage as much as possible. Then why, when it comes to invest in business, that we see that no banks, right? We have to fully operate on our own cash flow. Yeah, I don't want borrow any money for business. That's a wrong mentality, right? What we should do is go back to the principle: borrow when you can, not when you need it. Leverage the finance to invest in the business to facilitate business growth. To and also consider that finance cost in your business, right? In when we do the estimation, when we do the pricing. So that's a sustainable model. And build a reserve. That reserve can sit in the business, can sit outside the business. That's your choice. That's your freedom. But you don't have that facility, you're never going to get that freedom.
Yeah. And borrowing within the business, and particularly from the balance sheet, as I talk about, but borrowing for the business is productive borrowing. It's tax deductible
Yeah.
borrowing. Um,
Yeah.
and if we look, unfortunately, particularly in Australia and particularly in Melbourne, we've seen such increase in property prices that so much investment has gone into property rather than into productive items. So with the new capital gains tax and that coming in, we're at least seeing a swing round and perhaps some new direction as far as, particularly with capital gains tax on new builds, for investors are going to be very different than what they were for houses that are really built. So this should kick along the construction sector, and I think it's going to be better for the entire Australian economy.
Yeah, absolutely. I think that's a very good point, talking about this being a productive finance, right? So, yeah, if we looking at the return on investment, what each dollar of the borrowing in the business that is going to create, and we consider how quick the money actually turn in the business. You put money in, for example, in shares in property, it takes years for the money to turn. It will lock in that assets for a long time. But you put borrowing into the business that turns around every 8 months, 12 months, or even 6 months or less, depends on how long your project is. So that your return on investment in business is actually much bigger than in property.
Well, Victor, thanks for your time today. I think we've to cover a lot of areas in the construction industry. And we've even had some great discussions in relation to the economy. But I think we both agree that the attitude is important, and we are looking at better times. It's just a matter of working out how to work within the new structures. Thank you very much for your time today, Victor.
Thanks, Martin. It's really great to have this session with you together. Yeah, it's always great to take your insight about the finance, economy, and appreciate your help to my clients these years.
Thank you, Victor.